Oil prices climbed on Monday as stalled talks between the United States and Iran signaled continued disruption to Middle East energy exports, while global equity markets remained largely steady at the start of a week packed with major technology earnings and central bank decisions. Benchmark Brent Crude rose nearly 3% during the session, touching a more than 3-week high of $108.5 a barrel, fueling inflation concerns and prompting traders to scale back expectations of interest rate cuts in developed economies this year. Global equities showed mixed movement. MSCI's All-World Index edged slightly higher. Europe Stoxx 600 slipped around 0.2%, while markets in Tokyo and Seoul climbed to record highs, supported by continued optimism around artificial intelligence. Meanwhile, Wall Street futures moved lower. Analysts said the week ahead would be dominated by both geopolitical developments and key economic events, including multiple policy decisions across major economies and earnings reports from some of the world's largest technology companies. Despite a ceasefire halting much of the fighting following earlier United States and Israeli strikes on Iran, markets remain focused on the Strait of Hormuz, where shipping activity has been severely limited. The outlook for peace talks remains uncertain, with United States President Donald Trump saying Iran only needed to initiate contact if it wanted negotiations, while Iran's foreign minister traveled to Russia to seek support from President Vladimir Putin. Goldman Sachs has raised its year-end forecast for Brent crude prices to $90 a barrel, citing expectations that Gulf exports could return to normal by the end of June. However, the bank warned that prices could rise sharply if global inventories fall to critically low levels. In equity markets, investors continued to focus on the technology sector, particularly companies linked to artificial intelligence, which analysts say remains a strong driver of market optimism. Recent guidance from Intel, forecasting second quarter revenue above market expectations, helped boost confidence, pushing chip-heavy stock markets in Taiwan and South Korea to record highs and lifting their combined market value above that of Germany. A significant portion of the United States stock market is set to report earnings this week, including major technology firms such as Microsoft, Alphabet, Amazon, and Meta Platforms, with Apple scheduled to report a day later. Investors will be closely watching capital expenditure plans, particularly in relation to artificial intelligence. On the monetary policy front, major central banks including the United States Federal Reserve, the European Central Bank and the Bank of England are widely expected to keep interest rates unchanged, though their forward guidance could influence expectations for future rate moves. The Bank of Japan, which meets earlier in the week, is also expected to maintain its policy rate at 0.75%. Currency markets remained relatively stable, with the euro holding around $1.1746 and the Japanese yen trading just below the key 160 level. In Asia, technology stocks continued to lead gains. Taiwan's benchmark index rose 1.8% to a record close, bringing its gains for April to nearly 25%, its strongest monthly performance in more than 2 decades. South Korea's Kospi also reached a record closing high, rising 2.2%, with chipmakers leading the advance. Both markets have significantly outperformed their emerging market peers, driving broader regional indices higher. Analysts say strong demand linked to artificial intelligence is continuing to support earnings growth, even as concerns persist over inflation and disruptions to global energy supplies. Meanwhile, reports suggested Iran may be open to an agreement to reopen the Strait of Hormuz while postponing nuclear negotiations, offering some support to market sentiment. Elsewhere in Asia, stock markets in Thailand, Malaysia, and Indonesia posted modest gains, while currency movements were mixed, with some regional currencies strengthening slightly against the dollar and others remaining under pressure.